Master your money, free your future. Welcome to Budget for Life. My name's Jeremy. I'm not a professional YouTuber. I'm a financial advisor, but this video is not financial advice. This video is a breakdown, a beginning of the projections of GameStop's balance sheet post Q3. Once they announce their earnings in a month, what are we going to see as far as where their assets and liabilities stand as it is? I want to start that conversation. We're not going to finish it in this video because it would take too long. But a couple key insights that I want to share with you to help understand GameStop's balance sheet and project some moves that they might have made during their Q3. Before I get into it, thank you to those who join as fans of the channel, get some extra clout, fun ways to engage, and perks. Thank you to the friends who get some extra access as well to my GameStop spreadsheet and my client communication. And thank you to all those who are now joining the Halo Sub Club, the March to 2525. I'm hoping we can cross it before the end of the year. Would love for you to be a part of it. All the earnings this channel go to DRS Book GME shares, so I do appreciate the support. So, with balance sheets, most analysts don't project balance sheet numbers because GameStop could do any number of things in any given quarter. Any company could do any number of things that would dramatically change their balance sheet that they don't have to necessarily tell us in advance that they're going to do. One thing, for example, is as it relates to their cash, their cash level, one big variable is that they're currently holding this asset for sale and this corresponding liability for sale, which is GameStop's French division. So we know that they want to sell France, and we don't know if they're going to have sold it already or what portion they would have, how much money are they going to make from this sale. That's a big swing as far as cash value. Another big aspect is merchandise inventories. So how much do they scale inventory, or how much did they scale inventory in Q3? And then how much of that scale did they use cash to pay for, or did they just accrue accounts payable, right? Did they just get a 90-day interest free from the manufacturer, let the invoices pile up and we'll pay you after we sell those inventory products in Q4. We'll pay you in Q4 and Q1, but we need a couple hundred million more of inventory in Q3. Or did they go ahead and just pay for it in cash off the jump? These are choices GameStop has. And in the long-term big picture valuation of how you model the company, it doesn't really matter which one they choose as long as they're making decisions that you can evaluate their management team by and say, okay, this is rational, this is calculated. They're not taking on obscene risk, they're taking advantage of growth opportunities, right? They are shrewdly stewarding and managing the assets of their business and the costs, right? And the liabilities, the cost commitments that this business is making. So accounts payable, inventories, did France sell? Those are huge swings as far as what could ultimately happen within their balance sheet. Also, of course, did they deploy any cash? Did they buy any Bitcoin during Q3? Did they sell any Bitcoin during some of the different peaks of Q3? Did they buy any gold during Q3? They probably did not buy into equities based on Ryan Cohen's comments, general bearishness on the macro. But it doesn't mean that there's nothing they could have done with some of this cash pile or some of their digital assets, aka their Bitcoin value. So one thing I wanted to say as far as an insight is GameStop's anticipated French company sale. So they said at the end of Q1, right, they have these assets and liabilities held for sale related to the French division, and that the sale of the operations in France is expected to close during fiscal year 2025. But look what they said in the next quarter after Q2, their most recent 10Q. They say the sale of the operations in France is expected to close within the next 12 months. Do you see that difference there? So at the end of Q1, right? February, April, May. So, June 1st, they're saying, hey, within the next 7 months, we're going to sell this. And then 3 months later, right? So there's only 4 months left to go by, or I guess more like 5 or 6 if you're talking about fiscal 2025, because that includes January. But still, they come out and say, hey, in the next 12 months, we're going to sell this. In other words, to me, GameStop's cluing us that they're going to go ahead and make the holiday sales on the Switch 2 just now coming out. They're going to go ahead and make this money in 2025, let these growth numbers be that much more potent in 2025, right? They're going to make a push to blow out the operational income in 2025 and maximize the sales growth numbers, which if they sold France, right, they'd make however many $1 million that they sold it for, and they'd clean up their balance sheet a little bit, right? They'd reduce their assets and reduce their liabilities. They become that much more efficient as a company moving forward. But in the short term, they cut off all of the revenue that those stores would generate. And even though France in Q1 is an unprofitable business, even though France in maybe Q4 or Q3 of last year was an unprofitable business, in Q3 and Q4 of this year, with the Switch now out, it is very likely a profitable business. And I think GameStop is saying that we're going to go ahead and make this Christmas money and then we'll sell it, right? January, or maybe even wait till February, March, April, May, June of next year so that it hits in 2026. And that way, GameStop has that many more quarters to scale the Power Packs income, to scale the US hardware and software businesses, to grow those revenues largely enough to where they more than usurp the revenue loss that's going to happen when they sell France, right? Operating income will not take a huge hit with France out of the picture, but sales, it would be noticeable, particularly heading into a Q4 that should blow out numbers in a lot of ways. So GameStop saying, let's go ahead and table that balance sheet to-do list for 2026, and let's let the income statement make hay in 2025, and then continue to make hay in 2026, because again, this scaled growth will be ready to make up the difference from the revenue loss of France by the time we sell it in maybe Q1 or Q2 of 2026. So, what does that mean? It means that probably when we're modeling assets and liabilities, we can assume that those will continue to be on the books, right? This 177 here and that 151 there is probably still going to be a part of the picture. And where does that go in? So that's a piece of current assets and a piece of current liabilities. Let's see if we can solve this current assets and current liabilities. I'm going to set aside cash for now and really just talk about accounts receivables, inventories, prepaid expenses to get an idea of the other current assets, right? The non-cash, non-Bitcoin current assets. And what can we learn there? So quarter over quarter, receivables at the end of Q1 was 44.1 million. Receivables at the end of Q2 was 45.5 million. So an increase of $1 million quarter over quarter. But also you can see that it was around 60 million a year ago, right, at the end of Q2 last year, and stayed about 60 million at the end of Q4 last year. So let's see what we can learn about Q3 of last year to discern if there is a short-term bump in receivables just from that specific holiday ramp. And we see receivables right at 57.5. So, okay, receivables is continuing to come down year over year, right? You see it at 90 the year before that, and it does not particularly bump into Q3 as accounts payable do, right? Accounts payable started the year, right? Started 2024 at 324, and they added 150 million of accounts payable 3 months into the year. Receivables, you don't really see that, right? 57 at the end of Q3, 60 at the end of Q4, 60 at the end of Q2. So they went from 59.7 at the end of Q2 last year to 57.5 and then back up to 60.9. All that to say, what do you do with that receivables number? I think you keep it pretty steady. It's at 45.5. Last year it had a slight dip in Q3. So maybe it's back at a 44. So let's pencil in that portion, right? The receivables portion of their current assets. These assets held for sale, we're going to say is still that 177. I'm going to say they haven't changed the value of that, which I don't believe that they have. And then the current liabilities corresponding to that, while we're at it, is that 151.7 liability held for sale. What else forms these other current assets? We are looking at merchandise inventories. Let's do the prepaid expenses first, since it's a less of a needle mover. So at the end of Q2, they were at 36.6, right? A year prior, they were at 60. Then to start the year, they were at 39. And they were at 29 after Q1. After Q3 of last year, okay, so they do have a big spike in prepaid expenses. At least last year they did. A spike in prepaid expenses that hits in Q3 that then is paid off during Q4. At least that's what happened this past year. Q4 to Q3. So let's see if that happened as well the year before. We are looking at Q3 and Q4 of 2023 now. So here is the Q3 number. Here's the Q4 number. So Q3 of 2023, that prepaid expense was 57.7. So not high at all. Okay, very interesting. Whereas in the 10K, that prepaid expense was 51.4. So it goes from a 57 in Q3 to a 51 in Q4. So why last year did they prepay a bunch of expenses? And are they going to do it again? Prepaid expenses and other current assets, 119 a year ago. And what's happened since then? Down to 39 to begin the year. And then down to 29 another quarter later. Ultimately, back up to about 37, most recent number. Well, it certainly doesn't seem like it's going to go up by 80 million. I wonder how much of that, I wonder if they even tell us. Do they say anything about these prepaid expenses? Prepaid expenses, some of it is prepaid taxes, our cash, restricted cash is recognized, but that's not a huge needle mover. That's just a couple $1 million. That's it. That's all you tell us. What are these other current assets? You're not even going to tell me, are you? Current assets. Their long-term other current assets spiked as well in November. Okay, it's Italy. It's Italy. That's what happened. Current and non-current assets during the third quarter of Italy. So the Italy stores basically moved to a different point, a different part of the balance sheet once they announced that. And the amount of that was 63 million for current assets and 41 million for non-current assets, which if we look at the changes year over year, you see about a $60 million bump in current assets and about a $40 million bump in non-current assets. This is how we learn, guys. Great stuff. So that 60 and that 40 is an aberration. It is not going to happen again in this particular quarter. They have not listed anything new for sale in this quarter. They've already listed France for sale. So that change in balance sheet accounting has already occurred. So that prepaid expenses is continuing to, generally speaking, track down year over year. And if you were to take that 119 and take 60 million out of it, or the 60.4, what was it? 63 million. Okay, great. 119.4 minus 63 million. So if you net out that Italy, they were at a 56.4, which was about 10% higher than where they started the year, which they already. So right now they started the year at 39. Is it possible that prepaid expenses jump all the way from 36.6 to a 42? I think probably not. Because again, they keep shrinking their footprint all in all. They keep shrinking it. I wonder what was Q2 of 2024, how much of that 51 starting point to then the 56 in November, did that happen from Q2 to Q3 or did that happen from Q1 to Q2? That's what we want to know next. And we are going to find it right here. Show me. Okay, so it happened from Q1 to Q2. It goes from 51 to start the year to 60 million in prepaid and other current assets. So in that next quarter, this equivalent was 56.4. So it actually comes down about halfway between where it started the year and where it spikes after Q2. But this one didn't spike after Q2. It's already down after Q2. Jeez. But it came down a little bit. I'm going to say 35. I'm going to say it keeps coming down. 35 million in prepaid expenses and other current assets is my estimate. And that leaves us with inventories. Woo! Okay. So inventory 484. So again, if we look at last year, at the end of Q3, they were at 830 in inventory, whereas at the end of Q2, they were at 560. So from 560 to 830, that's a $270 pure dollar increase. And on a percentage basis, that would be about a 48% bump in inventory. So they started the quarter at 48.5 or 485 million. If you do a percentage basis, you'd say that jumps to 718. Or if you did the raw dollar, you'd say it goes to 755 of inventory. And what do I think the other X factor as far as projecting inventory is how much inventory value is GameStop logging for their collectibles business? How much of those Power Pack cards are staying in GameStop's possession as they sell them again and again and again, right? How much are they accumulating uh, graded cards, and how much is that inflating their inventory value? But if they're selling them as fast as they're buying them, which is what Ryan Cohen has said, then you would think the net inventory impact is still relatively modest. But in light of the fact that they're scaling, right, they're scaling revenue for sure, right? They are growing, and you would assume that the inventory impact is noticeable for that. I mean, but then again, February to August, look at the beginning of, oh, what I want to see, yeah, to start the year, they had 480 million in inventory, and that was based on the end of like the start of Q1. I wonder what did they do in Q1? They had 421 at the end of Q1. So at the end of Q1, after generating 732 million in sales, they had 421 million dollars in inventory. And here's the thing, guys, that next quarter, they do $240 million more in sales, and yet their inventory only goes up about $63 million. 240 million more in revenue, only 63 million more in inventory. And inventory simply recovers to where it started the year at, even though they're they're growing, right? At the end of Q2, oh man, it's hard not to think though that they're going to scale inventory a little bit more aggressively heading into this holiday cycle compared to what they did last holiday cycle, in light of the fact that they have the Switch 2 and collectibles to sell. And so, inventory value wise, I kind of want to bump it all the way to 800, but that feels a little bit, I mean, That feels a little bit aggressive. But if I called it 775, that puts you at a little bit more in current assets than Q3 a year ago, but a little bit less in inventory. Do I think they're going to have less in inventory than they did a year ago? Well, right now I'm projecting just barely less. Where is it? Barely less. I'm projecting 775, $50 million less in inventory with 1,000 fewer stores, right? That's the thing. 1,000 fewer stores, you know? But from a sales perspective, they did 1282 in Q4 of last year, and we're thinking they might do 1900 this year. So all that to say, it's really anyone's guess. And ultimately, what happens with the current liabilities as a result, and then we'll wrap up this video. Basically, PP&E is continuing to come down, no doubt, because they keep closing stores, right? So they were at 68.2 at the beginning of the year. They're already down to 52.3, and they were at 54 at the end of Q1. So shed a bunch of stores in Q1 and then another chunk, another few at least in Q2. I'm saying they're probably down to 50 or maybe 50. I mean, we could just call it 51 to be more conservative as far as their PP&E. Oh, that's an asset, not a liability. LOL. Long-term asset. Okay, then Bitcoin, right of use, deferred income. Let's go to the current liabilities because I want to show just the corresponding impact of inventory rising. That 484, basically whatever amount that GameStop increases their current assets, they basically increase their current liabilities the same amount, right? So Q2 to Q3 of last year, they had what, 730 million, or sorry, 330 million in current assets. And their current liabilities go up 320 million. So almost exactly the same. What about the year before? Current assets go up, what's that, 355 million, and their current liabilities go up, what is that? 355 million. I mean, basically, GameStop doesn't pay for this inventory spike with cash. They could, but historically they don't. They just charge the bill, right? And right now we have current assets going up about 300 million. And so you would expect current liabilities are going to go up about 300 million. And most of that is going to come from accounts payable and just other accrued liabilities. Now, that said, their operating lease liabilities are coming down. But that was true in the previous years as well, right? They were closing stores in these periods as well. So again, I think basically carrying that forward into the liabilities is a decent estimator of where the current liabilities will end up. 287 improvement or increase, I should say, on the 830 would put this figure at about 1117 total current liabilities. All right, let's wrap this one up so that you guys don't fall asleep. Hope you learned a little something. They're probably not selling France this quarter. Current assets proportionally are probably going to ramp up, but they're not going to impact the cash figure. Instead, they are going to temporarily balloon the current liabilities, the accounts payable and accrued liabilities, which will then get cleared off in Q4 and Q1 moving forward. That's going to mean that this cash number is going to be higher, even though they're scaling inventory by hundreds of millions. How much are they scaling inventory? In excess of what they did in previous years. How much is that counterbalanced by the lower store count and so the fewer stores that they need to stock with inventory? Very good question. How much of their power packs is in current inventory versus how much of that gets sold to the end user within the same quarter that they're able to purchase it? Even if a power packs card is sold 6 times before someone keeps it, well, if all 7 of those sales happen within the same quarter that they got the card, you're not going to see that inflate their inventory value. That's why I'm saying I expect a proportionally higher ramp going into Q3 and Q4, but I think it will be mitigated by the reduction in store count. And I do not think that Power Packs is going to inflate inventory values because I think that they genuinely are selling as fast as they're coming in, at least relatively or comparatively so. And so I don't think you're going to see a substantially larger business core operation to support the sales growth that's happening. I think the sales growth that's happening is an efficient sales growth that's not requiring GameStop to commit more and more resources to it. Or another way I should say it is as soon as GameStop is committing the resources to sell these products, they are selling the products, right? The Switch 2s that they're buying, they are selling. The collectibles that they're buying, they are selling. And so on the net, you're just seeing operating income skyrocket, sales continue to increase without liabilities ballooning or commitments ballooning in the meantime. That said, the ability to project the balance sheet with a lot of clarity is limited, but hopefully I'll learn something in this video. If you appreciated it, if you have any other thoughts, we'd love a like, a sub, a comment. That's all I got for y'all today. I will see you in the next one.